If you're wondering whether you're saving enough for retirement, you're asking the wrong question. The real question is, do you know exactly how much you'll need on the day you retire and every year thereafter, and do you have a systematic plan to get there? Hi, I am Faisal Haroon, and today I'm going to show you how to calculate your real retirement numbers, including complete withdrawal plan with automatic inflation adjustments, and then show you how to systematically build the investment account you'll need to get there. First, the legal disclaimer. This video is for informational purposes only. Please trade at your own risk with the money you're willing to lose. Please ensure that you agree with the terms of service at the link shown on the screen. If you continue to watch, it will be assumed that you agree. At Zehnlabs, we've created a retirement planner that cuts through the guesswork. Let me show you how this actually works with some realistic numbers. Our planner has two sections, the withdrawal section and the saving section. Instead of concentrating on how much to save, we take a different approach and figure out how big of a retirement account we need so that we can withdraw a comfortable amount every month throughout our retirement years. This withdrawal first approach gives us the exact capital requirement, the amount we need to have saved by the day we retire. Then our planner takes into account our current savings and works backward to determine the compound annual growth rate we need in order to achieve our retirement goal. Let's say you're planning to retire in 15 years and you figured out that you'll need $10,000 per month in today's purchasing power to maintain your lifestyle throughout retirement. That covers everything from daily expenses to travel, healthcare, and taxes for the next 25 years. Now here's where it gets interesting. The $10,000 you estimate today won't buy the same amount 15 years from now when you actually retire. Inflation will have eaten away at its purchasing power. And it doesn't stop there. Inflation keeps working against you throughout your entire 25-year estimated retirement span. But here's the good news. Our planner handles all of this automatically. It adjusts that $10,000 for inflation on day one of your retirement, then increases your withdrawal amount every single year to keep pace with rising costs. For now, we'll assume that the rate of inflation is 3%. Our planner shows that on the day we retire, we need $2.15 million invested at compound annual growth rate of 10% for us to be able to withdraw inflation-adjusted $10,000 a month for the next 25 years. You can view your entire year-by-year withdrawal schedule by clicking on the View Table button. As you can see, your first-year withdrawal will be about $187,000, which translates into roughly $15,600 per month. Considering 3% inflation, this is the amount you will need to withdraw after 15 years in order to have the purchasing power of $10,000 in today's money. Our planner automatically increases your withdrawals by 3% every year thereafter in order to keep your purchasing power constant at today's $10,000. Another good news is that the power of compounding works in your favor during retirement. Let's assume that during your retirement years, you invest your capital very conservatively at only 4% annually. Considering 3% inflation, our planner shows you'll need just over $4 million on day one of retirement. Now change the expected investment CAGR to 8%, a conservative estimate of the broad market return, and see what happens. Our required initial capital drops by about 35% to $2.6 million. That's the magic of compounding. Another knob you can turn to see the effect of compounding is the withdrawal period. Let's change it to 35 years. We get an additional 10 years for only $500,000 increase in our required initial capital. Notice that we're withdrawing roughly $200,000 a year from our retirement account. Without the effect of compounding, this increase would be just about $2 million. Let's switch it back to conventional 25 years, and our planner shows that we need $2.6 million in order to retire. Now let's shift our attention to the savings growth planning section of the planner. We know that we need $2.6 million on day one of our retirement. Assume that we already have $100,000 saved, and we can contribute an additional $500 monthly towards our retirement. If we want to retire in 15 years, our investments will have to grow at the compound annual growth rate of 22.4% for us to reach our retirement goal. Let's change the years to retirement to 12 years and watch the required CAGR increase to 29.2%. There are no right or wrong numbers to plug into these boxes. Take some time to contemplate on these questions. How much retirement savings do I currently have? What can I realistically contribute each month? And how soon do I truly want to retire? The key is to come up with estimates that you feel comfortable with. A couple of important considerations when you're doing your own calculations. Based on the historical data for the last few decades, it is conventional to use 2.5% to 3% inflation in future estimates. However, historically, there have also been periods where the inflation spiked into double digits. Since nobody can predict the future, I personally prefer to be conservative and use 4% inflation in my calculations. Next, I personally plan to keep using my tactical asset allocation strategies throughout my retirement, because these strategies have historically delivered higher returns with lower drawdowns compared to other approaches. But even so, I like to be conservative in my planning and use 8% to 10% for my retirement return assumptions, which is generally equivalent to the broad market returns. Our retirement planner is free to use and can be easily accessed on any device. Go ahead and play with it, and don't be afraid of the numbers you see on the screen. Again, the key is to come up with estimates that you feel comfortable with. Once you like your calculations and have your target CAGR, here's what to do next. Go to our homepage and look for strategies that exceed your required rate of return. You can start with one strategy, but as you get comfortable with the process, go ahead and diversify your capital across multiple strategies that meet your criteria. If you have to choose between strategies, make your selection based on both the performance metrics as well as the execution metrics. I covered the analysis of these metrics in a previous video, titled Getting Started with Tactical Asset Allocation Strategies. Successful retirement planning isn't about having perfect predictions or guaranteed outcomes. It's about having a clear plan based on realistic assumptions and the discipline to execute it systematically. It's okay to be imprecise and err on the side of caution, but in order for retirement planning to be useful, you should try to model your plan with numbers that are as realistic as possible. A genuine piece of advice from someone who has been trading for over 2 decades and has spent an enormous amount of time and effort in understanding the financial markets. Don't gamble with your retirement. If you think you can hit your target CAGR through day trading, stock picking, or just buying and holding broad market ETFs, I'd strongly encourage you to reconsider. You might also want to check out one of my previous videos titled Why I Trade Tactical Asset Allocation Strategies. Instead of hoping for the best, what I'm offering you here are back-tested, thoroughly analyzed strategies that I personally trade in my own retirement accounts. These strategies haven't just historically beaten the market, they've done it with much less risk. As an example, at the time of this recording on June 6, 2025, ETF Blend 120 has a CAGR of 48.07% as compared to that of SPY of only 12.7% over the last 10 plus years. The maximum drawdown of 120 is 16.81% as compared to that of SPY of 33.72%. Not only that, but the longest drawdown days of 120 are only 183 days as compared to that of SPY of 708 days. This is just one example. All of our strategies are designed to manage risk much better than the broad market while still delivering outstanding returns. The performance and execution metrics of all of our strategies are posted publicly and are updated on a daily basis. Most importantly, they're rule-based systems that remove the psychological stress and emotional decision-making that destroys most people's investment returns. What's more, they're simple to execute. You get a Telegram alert at most once a day when market conditions trigger a rebalance. You just adjust your account according to the allocations specified in the alert. That's it. The retirement planner and strategies are all available on our website, fintech.zehnlabs.com. We have a very simple getting started guide on our homepage that I recommend that you go through, and we also have a very comprehensive FAQ that I strongly recommend that you read before taking the next step. If you have any questions or concerns, please do not hesitate to get in touch with me. I really appreciate your time in watching this video. I wish you the best of luck in your retirement planning and hope that our service will really be beneficial in helping you achieve the financial freedom you deserve.